NYDIG may buy an idle Alcoa smelter site in New York, and the real story is what makes dead industrial land useful again in the Bitcoin era. The pressure point is simple. NYDIG's move on an old smelter shows how Bitcoin mining keeps repurposing heavy industry. Alcoa moves toward is the search phrase, but the valuable detail is how infrastructure, access, or execution changes after this headline. The tension here is simple. The loudest claim is not always the part with the strongest proof. Alcoa said it was in advanced talks to sell its 1,300-acre Massena East smelter site to NYDIG, with the site long inactive as an aluminum facility, but attractive for power-intensive digital infrastructure. That matters because Bitcoin mining increasingly follows power and property logic rather than the old image of random server racks chasing cheap electricity anywhere. That gives the story a hard anchor before sentiment starts doing the storytelling. The campus already has mining history through Coinmint and access to hydropower-linked infrastructure near the St. Lawrence River, which makes it unusually well-suited for high-load operations. In easy English, an industrial site with power access, land and grid connectivity can become valuable again even if its original manufacturing purpose is gone. This is where structure matters more than surface excitement. For people typing Alcoa moves toward, the next useful step is to separate what is already operating from what is only being promised. The move fits a broader trend in which former smelters and other industrial sites get reworked into Bitcoin mining or data center locations because the power arrangements, land scale, and grid connectivity already exist. That detail is often where the risk moves from theory into actual exposure. The mechanism is infrastructure recycling. Bitcoin mining needs cheap, stable power and room for equipment. Heavy industry sites often already solved those hard physical problems decades ago, even if the original business model no longer works. For people searching, KW, the practical takeaway is that mining expansion now looks as much like infrastructure redevelopment as it does like pure crypto speculation. Once that mechanism is visible, the pricing story gets easier to read. That matters because the Bitcoin mining map is increasingly shaped by energy contracts and real estate logic, not just by who can buy the newest machines. Old industrial America is becoming part of the mining story for exactly that reason. The more this trend continues, the more mining will be shaped by long-term energy deals, local politics, and site reuse opportunities. This is why users, traders, and treasury desks can react very differently to the same headline. What remains unclear is the final sale timing, how the site would be expanded or reconfigured under NYDIG ownership, and how legal disputes around Coinmint's ownership structure might affect the operating picture. Watch whether the deal closes, whether NYDIG pairs mining with broader high-performance computing uses, and whether other idle industrial assets keep moving into digital infrastructure instead of traditional manufacturing reuse. The uncertainty is part of the valuation, not a side note after it. That leaves Alcoa moves toward waiting for follow-through, because infrastructure only matters once users, institutions, or customers actually rely on it. The more old industrial power sites become digital campuses, the clearer it gets that Bitcoin mining is now an infrastructure business as much as a crypto business. Once the noise is stripped away, follow-through is the only thing that can confirm the pitch.